Hey everyone, and welcome back to The Explainer. Today, we're taking something that usually gets brushed off as this dry, back-office logistical chore, and we're going to flip it on its head to transform it into your absolute most powerful frontline sales strategy. Yep, we are talking about the 2026 Equipment Financing Playbook. Look, whether you're out there selling equipment, buying it, or managing the capital behind it, the way deals get funded is shifting dramatically right now. So, we're going to break down the exact tactics, the data, and the frameworks that will literally help you close more deals and protect your margins this year. Let's get right into it. Okay, get this. 60% of B2B buyers abandon purchases simply because of complicated payment terms or approval delays. 60%. Just think about the massive pain point of all those lost deals. I mean, your customer desperately needs the equipment, they absolutely love the product, but the sheer friction of figuring out how to pay for it or suddenly getting hit with massive sticker shock, it just causes them to walk away entirely. If you're leaving the financing up to the customer to figure out on their own, well, you're essentially just holding the door wide open for your competition to swoop right in. And the stakes we're talking about here are absolutely explosive. $1.3 trillion, that's a trillion with a T. That is the current size of the U.S. equipment finance market, and it is actively, aggressively growing. So this is definitely not a shrinking sector we're dealing with. Capital is increasingly available, and businesses are ready to invest. The question really isn't whether the money is out there, but whether you and your team are positioned strategically enough to actually capture it. So what's actually fueling this massive boom? Well, we've got some serious macro tailwinds driving growth for 2026. We are looking at a projected 6.2% increase in overall equipment and software investment, right alongside a 5.9% rise in new origination volume. Why the sudden jump? Well, it's pretty simple. All those deferred investments from the past few years are finally catching up. And on top of that, you have these rapid technology-driven replacement cycles. I mean, machinery from just 3 years ago might already put a company at a competitive disadvantage today. Throw in the massive momentum from recent infrastructure spending and domestic manufacturing reshoring, and the picture becomes crystal clear. This market is moving fast.
So, Tactic 1. Selling the monthly payment.
Because if you're waiting until the very end of a deal to talk about money, honestly, you've already lost control. Hitting a buyer with a terrifying, margin-crushing lump sum right out of the gate instantly triggers defensiveness. It creates sheer panic, and you immediately start getting demands for steep discounts. But if you quote a manageable monthly payment right from the start, it changes the entire psychology of the sale. It's so much easier for a customer to imagine fitting a smaller payment into their monthly budget. That approach totally minimizes that initial sticker shock and, crucially, protects your profit margins, because you don't have to strip out your value just to get them to say yes.
To do this the right way, you really need to walk chronologically through the early sales process using 3 specific prep questions. First up, ask, how long do you plan on keeping it? Boom, that gives you a clear target for the financing term. Second, just ask them point blank. Do you plan on financing your new equipment? Bring it up early, make it normal. And third, what do you do with your old equipment? This instantly tells you whether or not you need to build in a trade-in program. Asking these 3 things before you ever bring up a total price gives you total control over the conversation.
All right, moving right along to Tactic 2, flexibility over one-size-fits-all.
Because in 2026, forcing a customer into a rigid, cookie-cutter monthly payment that completely ignores their actual cash flow reality, yeah, that's a total recipe for disaster. Business cash flow almost never behaves like a perfectly flat line, so your financing terms shouldn't either. Matching the financing structure to the buyer's actual revenue model is exactly how you win deals. Selling to agriculture or landscaping, the revenue peaks in very specific months, so you offer them seasonal financing. Selling heavy iron for a new construction project. Hook them up with deferred payments so they have, say, 90 days to mobilize and actually start making some money before that first bill is even due. For tech sectors that are constantly worried about obsolescence, you roll out a fair market value lease so they have the option to upgrade later. Tailoring the structure to this specific industry is how you actually lock in that commitment. Now, to justify these payments to buyers who are getting increasingly savvy, we have to shift the conversation over to TCO, or total cost of ownership. Basically, TCO is the true overarching economic cost of purchasing, operating, and eventually disposing of goods over their entire life cycle. By zeroing in on TCO, you're giving yourself the intellectual ammunition to prove that your equipment, even if it carries a slightly higher initial price tag, is actually going to save them serious money over time, whether that's through massive productivity gains or just lower day-to-day operating costs.
Think about it. When a customer buys equipment, they are paying for way more than just the purchase price.
A solid TCO framework basically maps costs into 3 distinct buckets. First up, your one-time costs, so that's the initial purchase, taxes, maybe the infrastructure setup. Second, and this is usually the big one, are the recurring costs. We're talking energy, fuel, maintenance, insurance, all throughout the equipment's lifespan. And third, you have social costs, which are externalities like emissions. By showing your customer this full, big-picture view, you can easily prove how a slightly higher monthly payment on a better piece of machinery drastically reduces those really heavy recurring costs.
And of course, these costs do not exist in a vacuum. It's a dynamic setup. You've got variables constantly shifting the equation, things like technology learning rates, geographical application, production discount rates. All of this influences everything from profit margins to energy consumption. It even factors in how things like equipment downtime and emission costs play a role. When your sales team truly grasps these interconnected factors, they aren't just selling a piece of machinery anymore. They're acting as a highly strategic financial consultant for the buyer. And that is a game changer.
Okay, let's switch gears and talk about Tactic 3, leveraging AI underwriting. This is a massive 2026 trend that is fundamentally changing how fast we get deals approved. Because honestly, the days of waiting weeks for a bank to manually underwrite a deal, those are quickly coming to an end. Here's exactly how AI is changing the game on the front lines. It's delivering faster, fully automated decisions by instantly integrating alternative data signals, things like real-time cash flow patterns and industry trends, not just staring at traditional credit scores. This directly leads to broader credit consideration and way more accurate risk pricing. It just completely trims down the administrative burden. But, and this is a really crucial caveat here, while AI is amazing at speeding up standard deals, real human expertise is absolutely still required for those complex, nuanced transactions. You need a partner with fantastic tech for sure, but you also need great people backing it up.
So, Tactic 4, defense against pitfalls. We've talked about how to grow, but what about the risks?
Because while offering financing is an incredibly powerful tool, if you execute it poorly, you can actually erode customer trust and totally stall out your own sales pipeline. You've got to know how to protect your brand. Let's rapid fire through some defensive plays. Pitfall number 1, overcomplicating terms. The fix, super simple plain language and clear side-by-side cost comparisons. Pitfall 2, ignoring cash flow. Well, we solved that earlier by providing tailored, industry-specific structures. Pitfall 3, failing to train your sales teams. Look, if your reps are terrified to talk about money, you have to provide them with scripts, FAQs, and seriously, do some role play with them. And finally, neglecting compliance. Sneaking in hidden fees will absolutely destroy your reputation. The solution here is to always partner with transparent, direct lenders who stick to strict ethical standards. All right, wrapping things up here, I want to leave you all with one final, kind of provocative thought. Ask yourself, are you just selling equipment or are you actually funding possibilities? Because if you can stop viewing finance as this annoying back-end logistical chore and instead start using these strategies to bring flexible, tailored capital to your customers super early in the process, financing literally becomes your greatest growth engine for 2026. Thanks so much for joining me on this explainer, and I will catch you in the next one.